So, stock trading, right? It's all about exchanges, brokers, and these financial instruments. You need to understand how orders work.
Exactly. And understanding limit orders, different markets, and capital management like anti-martingale is crucial. For a trading system.
So, brokers are essential in stock trading. They connect traders to multiple exchanges, right? That's good for wider market access.
Absolutely. And they provide real-time market data, analysis, and even help with investment strategies. It's a crucial link in the process.
And different financial instruments like stocks, bonds, and even cryptocurrencies can be traded through brokers.
Exactly. Understanding these instruments and their characteristics is a key first step for anyone diving into trading.
So, currencies are traded on foreign exchange markets, right? That's a whole different kind of market from the stock market.
Absolutely. And derivatives, like futures and options, are based on other assets. They're a bit more complex.
Indexes, like the S&P 500, represent a portfolio of stocks. They're a way to track the overall market performance.
Right. And investment funds pool money from many investors for diversified investments. Pretty smart.
Cryptocurrencies are new digital assets. They use cryptography for security. That's interesting.
Exactly. And dividends are important for shareholders. They can be paid on many different financial instruments, not just stocks.
Tickers are important for identifying assets. They're like short codes for stocks, currencies, and commodities.
Exactly. They make it easy to track prices and see how different assets perform. Makes things a lot simpler.
So, Tesla is for Tesla stock, CHPIA is for yen/dollar, and CC1 for Cocoa.
Right? ADOSD is for Cardano crypto against the dollar. It's all about clear identification.
Now about order execution. Brokers handle orders, right? Traders give instructions.
Yes, traders send orders to brokers for execution. Orders have details like type, direction, asset, and volume.
Different order types exist, like market and limit. Market orders execute at current price. Limit orders specify a price.
Market orders change supply/demand immediately, while limit orders create a place in the order book. Understanding this is crucial.
Stop orders are activated when a price is reached. Time and force determines how long an order stays active.
Right, and essentially there are just market and limit orders. Market orders execute at current prices, while limit orders have a desired price.
So, after creation, orders go to the order book. This shows all orders for a particular asset.
Precisely. Market orders quickly adjust the order book, impacting supply and demand. Limit orders show potential buys and sells at specific prices.
This difference is key. Market orders execute immediately, affecting market depth. Limit orders sit, showing trader intent.
Exactly. Limit orders provide visibility into market sentiment and potential support and resistance levels. A key concept.
So, a market buy order for 20 lots fills at different prices. It's not all at once.
Exactly. Filling at available bids. It grabs what's available first. Not always smooth.
A financial instrument has a bid and an ask price. That's the quote.
Yes, the bid is the highest by price, the ask is the lowest sell price. The spread is the difference.
The spread depends on liquidity, volatility, and broker fees.
Right, more liquid, less volatile assets typically have tighter spreads. It's all about the market.
Leverage lets traders use more capital than they have.
Correct. Leverage multiplies their buying power. It's a tool for risk and reward.
Leverage is tied to margin, a deposit to cover potential losses.
Exactly. Margin is the collateral. Leverage magnifies potential gains and losses.
So, margin is like a down payment for a trade, right?
Exactly. It's the portion of the total trade amount a trader needs to put up.
And leverage is how much the broker lends beyond that.
Correct. It amplifies both potential profits and losses.
Initial margin is the minimum for opening a new trade.
Yes, and maintenance margin keeps a position open.
So, traders are essentially borrowing money to trade larger amounts?
Precisely, with a risk-reward trade-off.
And there are fees associated with using leverage.
Yes, for the broker providing the additional capital.
It's crucial to be cautious with leverage. Market swings can increase losses quickly.
Absolutely. It magnifies potential losses beyond your initial investment.
Now about the trading system's architecture. What's its core purpose?
To generate income, either primary or supplemental.
But we can't evaluate its potential until real testing.
True, only real market conditions reveal effectiveness.
So, the core goal of any trading system is to generate income?
Yes, either a primary or secondary source of income.
But this goal's value isn't clear until the system's tested in the real market.
Exactly, backtesting and forward testing can only hint at potential. Real market conditions are key.
Okay, after establishing the goal, what crucial steps follow?
Developing a trading strategy, testing rigorously, managing risk and capital, and assessing the system's effectiveness.
These aspects need separate modules within the system?
Yes, each module handles a specific function, all working together in a complete trading cycle.
The first crucial module is forming a trading theory, correct?
Correct, choosing a style, fundamental or technical analysis, market type, time frame, strategy, and defining the signal generation rules.
Testing, then, is equally critical for validating a strategy?
Absolutely, using historical data, defined metrics, and different testing approaches, backtesting, forward testing.
Capital management and risk control are next?
Yes, determining an appropriate position size, using stop-loss orders, diversification, and constant reassessment.
Then measuring efficiency?
Yes, tracking performance metrics like profitability, Sharpe ratio, and maximum drawdown, for example.
And optimizing for better performance in real conditions?
Yes, using algorithms to find the best parameters and settings within the specified limits.
So, evaluating the system's quality involves calculating key metrics like profitability, Sharpe ratio, maximum drawdown, and profit factor.
Correct. These metrics provide a benchmark for potential success.
Optimization, then, fine-tunes the system's parameters for maximum efficiency?
Precisely. Optimization algorithms aim to achieve the best settings.
But even with these modules, a trader can build a unique system, right?
Absolutely. Each trader can craft a system different from others.
Before actual trading, a trading theory is essential.
Indeed, it forms the rules for entering and exiting the market.
And how is this theory developed?
Through various approaches like technical and fundamental analysis.
Technical analysis focuses on price and volume charts, right?
Yes, seeking patterns to predict future price movements.
Fundamental analysis, on the other hand, looks at underlying factors?
Correct. Financial, economic, and other fundamental data are studied.
A mixed approach combines both methods, is that right?
Yes, leveraging both technical signals and fundamental data.
So, a mixed approach combines fundamental and technical analysis.
Correct, using both to predict market movements more precisely.
And what about automatic theory formation?
Algorithms and machine learning create and optimize strategies from historical data.
How does that work?
Algorithms analyze data, identify patterns and trends, then generate trading signals.
Event trading is different, isn't it?
Event trading focuses on short-term reactions to news and events.
So, the trader needs real-time awareness in event trading?
Yes, to capitalize on volatility.
Finally, unique theories are possible.
Yes, traders can spot previously unnoticed patterns.
So, the choice of approach is personal?
Absolutely, depending on individual preferences and style.
What makes technical analysis popular?
Its use of graphs makes it accessible and easy to understand.
How can technical analysis be automated?
Its straightforward nature allows for robotic trading systems.
So, technical analysis uses historical data for testing, which makes it easy to analyze strategies. How does that help automation?
The historical data allows for the creation of trading systems that don't require constant market monitoring.
Right. Graphical analysis uses charts to predict future price movements. What kinds of charts are used?
Candlestick, bar, line, point and figure, and Renko charts.
What are indicators and oscillators in technical analysis?
Mathematical expressions based on price and volume, used to assess the market and identify trends, potential reversals, or overbought/oversold conditions.
How do these indicators help assess general trends?
They show the direction and strength of the market movement. Indicators are often plotted as lines or curves on charts.
Are there different types of indicators?
Yes, trend indicators, oscillators, volume indicators, volatility indicators, momentum indicators, and cyclical indicators. Each type focuses on different aspects of price movement.
Could you give an example of a trend indicator?
Moving average MA is a common example. It helps determine the general direction and strength of a trend.
So, trend indicators show the trend's direction and strength. What about oscillators?
Oscillators measure market overbought/oversold conditions and potential turning points. They fluctuate around a central line.
Can you give an example of an oscillator?
The Relative Strength Index, RSI, is a common oscillator.
And volume indicators? What do they focus on?
They analyze trading volume to assess trend strength and direction.
Are there any that combine price and volume?
Yes, volume-weighted average price, VWAP, and money flow index, MFI, combine price and volume data to determine average price based on trading volume.
What about volatility indicators?
Volatility indicators like Bollinger Bands and Average True Range, ATR, show price volatility, helping to identify support and resistance levels and market conditions.
Momentum indicators, what do they measure?
They measure the momentum of price movements, helping find potential turning points.
And cyclical indicators?
Cyclical indicators like Detrended Price Oscillator, DPO, and Shaft Trend Cycle highlight cyclical patterns in price data to predict future trend changes.
Finally, other indicators?
Other indicators such as Ichimoku Cloud, Elliott Wave Theory, and Gartley Pattern identify chart formations for price prediction.
So, what's the difference between leading and lagging indicators?
Leading indicators try to predict future price changes, while lagging indicators confirm current trends. RSI and stochastic are leading examples. Moving averages are lagging.
Why is combining indicators important?
No single indicator guarantees success. Combining them and considering supporting factors improves accuracy.
What is trend analysis about?
Identifying the direction of price movement for a financial instrument. It's about determining if the trend will continue or change.
How are trends categorized?
By duration, short-term, medium-term, long-term, and direction, upward, downward, sideways.
Can you describe an upward trend?
An upward trend shows a gradual price increase, like a staircase going up.
So, geometric analysis looks at patterns in price charts. What are some of the key shapes?
Triangles, ascending and descending, diamonds, wedges, flags, double peaks, and head and shoulders patterns are common.
How do Fibonacci retracements work?
They use Fibonacci numbers like 23.6%, 38.2%, 50%, 61.8%, 76.4% to identify potential support and resistance levels after a price move.
Can you give an example?
If a stock price rises and then corrects, a trader can use Fibonacci retracement to pinpoint potential support levels.
What about Fibonacci extensions?
Extensions use the same Fibonacci numbers to predict potential price targets, or the continuation of a price trend.
So, 161.8%, 261.8%, and 423.6% are common extension levels?
Yes, traders often use these levels to forecast where the price might go.
How do these tools relate to technical analysis overall?
They're tools used within technical analysis to identify patterns and predict future price movements. They help to pinpoint support and resistance, which are crucial for trading decisions.
Okay, so what's the key difference between Fibonacci retracement and fundamental analysis?
Retracement is a technical analysis tool focusing on price patterns. Fundamental analysis looks at the company's financial health and industry trends.
What kind of information is crucial in fundamental analysis?
Company financials like profit and loss, balance sheets, and cash flow. Management quality and industry outlook are also key.
How does the evaluation of competitors fit into this?
Evaluating competitors and their market share provides insight into the company's standing within the industry.
In political events?
Global and political factors affect a company's operations, influencing its valuation.
So, fundamental analysis is a really comprehensive process?
Yes, it involves a large amount of data collection and analysis to assess the true value of a company.
Is there a way to combine these different types of analysis?
Absolutely. Combining technical and fundamental analysis can lead to more informed decisions. A mixed approach considers both price patterns and underlying factors.
So, fundamental analysis is crucial for long-term investment decisions due to the amount of data involved. How does it factor into short-term trading?
Fundamental analysis can still inform short-term decisions. For example, news about a company or its industry could influence short-term price movements.
How do you use that information to inform trading decisions in the short term?
You can combine fundamental analysis with technical analysis. A change in a company's outlook, suggested by fundamentals, could be supported by price patterns visible in charts.
What about volatility? How does that play a role in trading decisions, especially with different analysis types?
Volatility is a significant factor in both technical and fundamental analysis. High volatility increases risk, necessitating adjustments to risk management techniques.
So, what specific adjustments might a trader make in high volatility conditions?
They might use tighter stop-loss orders, adjust position sizes, or even temporarily avoid certain assets. The trader needs to be more cautious.
How can a trader integrate technical tools, such as indicators, to understand fundamental signals better?
Technical indicators can help confirm or contradict signals from fundamental analysis. A positive fundamental trend could be reinforced by upward technical indicators.
Are there examples of how this mixed approach might be used?
News about a company's positive earnings could be complemented by upward momentum indicators or chart patterns to strengthen the signal for a potential trade.
Does the choice of instruments affect the combination of analyses?
Absolutely, certain instruments may lend themselves more to one type of analysis than the other. Highly volatile assets might be more suitable for technical analysis, while established companies could be evaluated with more emphasis on fundamentals.
Okay, so how does volatility impact the choice of analysis time frame?
High volatility often leads traders to shorter time frames. Quick responses are needed to capitalize on rapid price changes.
What are some specific volatility indicators traders use?
The volatility index, VIX, true average range, ATR, and Bollinger Bands are common examples. Others include Chaikin volatility, volatility stop, and volatility momentum.
How do these indicators fit into a trader's overall strategy?
Volatility indicators help a trader gauge the risk level and adjust their strategies accordingly. Higher volatility might necessitate smaller position sizes or more cautious entry points.
So, volatility is a crucial consideration for both fundamental and technical analysis?
Exactly. Fundamental factors like news events can impact volatility, and technical analysis relies heavily on price fluctuations for identifying trends.
How does understanding volatility help in forming trading signals?
Understanding volatility helps you create signals that are more relevant to current market conditions. For example, a high volatility environment might trigger signals based on rapid price changes or deviations from expected trends.
Now let's talk about forming trading signals. What's the next step after choosing a strategy?
Defining clear entry and exit conditions is crucial. This forms the basis for generating specific signals.
So, after establishing entry conditions, what's the process for defining exit conditions?
Exit conditions need to specify when to close a position. Look for signals indicating a trend reversal or reaching a target profit.
Can you give a more concrete example of an exit condition?
Sell when the price touches the upper Bollinger Band on the daily chart and the width is relatively high. Confirm with overbought RSI on the 4-hour chart.
Why are both time frames necessary for exit?
The daily chart provides a broader picture of price movement, while the shorter time frame, 4-hour, adds confirmation.
How do you manage risk with these exit conditions?
You set stop-loss orders to automatically close positions if a trade moves against you.
What are some other common exit conditions besides hitting a target profit or stop loss?
Traders might set a trailing stop to lock in profits as the price moves further in their favor. They could also use a break-even point and exit when the trade breaks even.
How do exit conditions factor into the overall optimization process of a trading strategy?
Exit conditions are critical components that need rigorous testing and optimization. Adjusting these can greatly impact the overall performance of the strategy.
With numerous indicators and time frames, how do you avoid over-reliance on a single exit signal?
You need multiple confirmation signals. For instance, combining RSI with the Bollinger Bands creates a more reliable exit signal.
So, clear exit conditions are crucial to managing risk and maximizing profit?
Precisely. They represent the calculated limits and reactions to market movements.
So, a trading signal is just a specific action based on the conditions?
Correct. It's the instruction to buy or sell an asset.
What's the practical application of this example signal?
The signal instructs a buy if the price touches the lower Bollinger Band on the daily chart and the band's width is narrow, confirmed by an oversold RSI on the 4-hour chart.
Why is starting with simpler strategies like moving averages a good idea?
Basic knowledge of indicators is essential. Building on that foundation allows for more complex strategies later.
What happens if a trader doesn't manage capital?
Significant losses are possible. A trader might risk their entire account on a few high-risk trades and lose a substantial portion of their capital in unfavorable market conditions.
How does capital management help avoid this?
Capital management strategies like fixed position sizing limit the risk per trade, preserving more capital overall.
Can you elaborate on fixed position sizing?
Fixed position sizing involves risking a consistent amount or percentage of capital on each trade, regardless of the total account balance.
What are the benefits and drawbacks of this approach?
The simple but can be risky with small capital amounts. A fixed percentage approach adjusts to account changes but doesn't account for volatility.
So, capital management is crucial for avoiding large losses and maintaining a healthy trading account?
Absolutely. It helps prevent emotional decisions and preserves capital during difficult market periods.
What's the most basic, yet effective, capital management strategy?
Dividing your capital into parts. Don't put all your funds into one risky trade.
Why is optimal position sizing important in capital management?
Optimal position sizing directly affects the effectiveness of your capital management method.
Can you explain the concept of fixed position sizing?
It involves a consistent trade size, regardless of your overall account balance. You risk a set amount or percentage on each trade.
Are there different ways to implement fixed position sizing?
Yes, you can risk a fixed amount of money per trade or a fixed percentage of your capital.
What are the potential downsides of fixed position sizing?
With limited capital, it can be too risky. It doesn't adjust for changing volatility, which can be a problem.
How does a fixed percentage approach differ?
It adapts to account changes but still doesn't consider volatility. You need to recalculate frequently as your account fluctuates.
Are there other capital management methods beyond fixed position sizing?
Yes, methods like the Kelly criterion, optimal F, martingale, anti-martingale, and fixed proportional position sizing offer different approaches.
A fixed percentage approach seems better for larger accounts, but doesn't account for volatility. How does the Kelly criterion address this?
The Kelly criterion aims to find the optimal bet size considering probability of winning, probability of loss, and average win/loss ratios.
So, it's a formula to determine the ideal percentage of capital to risk per trade. Could you give an example of how it works?
If the probability of winning is 48%, X equals 0.48, and the average win is 2.33 times the average loss, then the optimal bet size is 22.68% of your capital.
That seems quite complex. What are the main advantages and disadvantages of the Kelly criterion?
It theoretically optimizes bet size for maximum long-term returns, but you need accurate probabilities and win/loss ratios.
If those aren't perfect, is it still a valuable tool?
It provides a framework for thinking about risk and reward in a probabilistic way, and the calculation helps focus on probabilities instead of feelings. It is not a perfect solution in practice.
So, the Kelly criterion calculates an optimal bet size based on probabilities. How are the win/loss ratios used in the formula?
The win/loss ratio, Z, is the average profit divided by the average loss. Is a crucial element in determining the optimal bet size.
The example shows a win-slash-loss ratio of 2.33. What does that imply in terms of the optimal bet?
A 2.33 win-slash-loss ratio indicates a higher potential for profit compared to the potential loss. The formula then suggests a 22.68% risk per trade.
But this example relies on historical data. How reliable is this in real-time trading?
It's less reliable because past data may not accurately predict future results. The optimal bet for one period might not be suitable for another.
Are there other considerations to keep in mind and limitations of the Kelly criterion?
Accurate probabilities are needed for the formula to work effectively. If these aren't precise, the calculated optimal bet size might not be optimal in practice.
Is there a better method to determine the best bet size in real-time trading?
The optimal F method aims to find the ideal bet size by maximizing the total win ratio, TWR, but it also depends on historical data. It's theoretically better, but not a perfect solution.
Martingale seems risky. Why is it not a recommended strategy?
Martingale doubles your bet after each loss, aiming to recoup losses with a single win. It ignores capital limits and can quickly deplete your funds if losses continue.
So, the risk of total capital loss is very high with Martingale?
Absolutely. Market fluctuations can easily lead to a cascade of losses. It's not suitable for most trading situations.
What are the key limitations of Martingale?
It completely disregards capital limits and is based on the assumption that a winning trade will eventually occur. This isn't always the case, leading to significant losses.
Are there any situations where Martingale might potentially be useful?
Potentially in very short-term, high-volatility trades where the chance of a rapid turnaround is high. However, this is exceptionally risky and not recommended for long-term strategies.
Given the high risk, how does Martingale compare to other methods like fixed position sizing?
Fixed position sizing risks a constant amount per trade, offering a lower risk approach. Martingale, in contrast, escalates risk dramatically with consecutive losses.
In essence, Martingale is a highly volatile method. Does it have any advantages compared to anti-Martingale?
Martingale potentially provides a quicker path to a large gain, but the risk of catastrophic losses is immense. Anti-Martingale offers less volatility, but doesn't guarantee profit as quickly.
Martingale doubles the bet after each loss. What's the underlying logic?
The logic is to recoup previous losses with a single win. It assumes a winning trade will eventually occur.
But the example shows 3 losses before a profit. Doesn't this highlight the significant risk?
Precisely. A series of losses quickly consumes the initial capital, even with a subsequent win.
The example returns to the initial bet size after a win. Why is this important?
This illustrates how quickly the bet size can escalate, consuming capital with each loss.
What if a trader experiences a long string of losses?
This quickly exhausts the entire capital base, highlighting the extreme risk of this method.
Some traders use a smaller multiplier, not doubling. How does this impact the risk?
A smaller multiplier reduces the rate of capital depletion, but the risk of a long losing streak still remains.
So, a crucial limitation is the lack of a safeguard against prolonged losing trades?
Correct. There's no mechanism to prevent total capital loss if the market moves against the trader for an extended period.
Given this inherent risk, what are the conditions for Martingale's potential usefulness?
It might potentially be useful in very short-term, extremely volatile markets with a rapid turnaround possibility, but even there, the risk is immense.
Anti-Martingale increases bets after wins, but decreases them after losses. How does this differ from Martingale?
Martingale increases bets after every loss, escalating risk rapidly. Anti-Martingale increases bets only after a win, potentially mitigating some of that risk.
So, anti-Martingale seems less risky than Martingale?
Potentially, but it still carries risk. A string of losses can quickly erase any initial gains.
What's the typical progression in anti-Martingale?
Double the bet size after a win and reduce it after a loss. It's a less aggressive approach than Martingale.
How many trades are typically recommended in anti-Martingale?
3 trades is often the upper limit. Opening more can be problematic.
The text mentions a smaller multiplier. How does that change things?
Using a smaller multiplier like 1.3x instead of 2x reduces the pace of bet escalation but doesn't eliminate the risk.
Is there a risk of losing even with profitable trades using anti-martingale?
Yes, a string of losses can still wipe out early gains. It's just less fast-paced risk.
What's the key difference in risk between anti-martingale and fixed proportional sizing?
Fixed proportional sizing is less reliant on a specific winning streak. Anti-martingale is more dependent on the order of wins and losses.
How does fixed proportional position sizing work?
A trader sets a fixed percentage or amount to risk per trade, which is not influenced by prior wins or losses.
What advantage does fixed proportional have over anti-martingale?
Fixed proportional is less prone to large swings, providing more stability over time.
What is the core concept of fixed proportional sizing?
It aims to balance risk and profit potential by maintaining a fixed proportion of the capital at risk per trade.
How does the concept of delta apply to fixed proportional?
Delta defines the point at which a trader increases their position size, often in relation to capital growth.
So, fixed proportional position sizing uses a delta. What exactly is a delta in this context?
A delta is a fixed value, a proportion, that triggers adjustments to position size. It determines when to increase the trade size.
How does the delta relate to the trader's aggressiveness?
The smaller the delta, the more aggressive the strategy. A smaller delta leads to faster increases in trading volume.
The text mentions adjusting delta for drawdown. Can you explain?
When losses occur, the delta for reducing position size might be adjusted to a lower amount to preserve profits.
The formula shows a direct link between capital levels and position size. Explain.
Increased capital triggers an increase in the allowed position size.
Looking at the example, starting with $5,000 and a $4,000 delta, how does the calculation work?
The capital increases to $9,000 after one lot and to $17,000 after two lots.
So, essentially, the delta dictates how quickly the position size increases?
Yes, the delta sets the threshold for expanding the size of the trade in relation to how much capital the trader has.
How does the delta affect recovery from a drawdown?
A smaller delta for reducing the position size during a drawdown can allow for a quicker recovery of lost capital.
Does the delta change during different market phases?
The delta is a variable value in the calculation and is determined based on the trader's trading method or style.
So, the delta for drawdown can be adjusted, potentially making the recovery faster?
Yes, a smaller reduction delta might speed up the recovery from losses.
How does this smaller delta affect the growth phase?
A smaller growth delta results in a faster increase in trading volume during periods of profit.
The example with $5,000 delta and $150,000 account. How does that lead to $132,500?
The drawdown calculation reduces the capital by a portion calculated from the difference between the current and previous levels, adjusted by 0.5.
So, the $132,500 represents the new capital level after the drawdown?
Yes, it represents the new capital level following a drawdown.
What's the core idea behind the different deltas for growth and reduction?
To balance the potential for growth with the speed of recovery during drawdowns. A quicker growth delta might be offset by a slower recovery delta to protect profits.
The text mentions the chosen delta reflecting a trader's style. Explain.
A smaller delta means a more aggressive approach, leading to quicker volume increases, while a larger delta is more conservative.
Besides recovery speed, what other factors influence choosing the optimal delta?
Testing and adjusting the delta to best suit a trader's specific trading strategy and risk tolerance.
So, risk control is about managing potential losses. What's the key idea behind it?
The core goal is preserving capital and profits. Effective risk management lets you handle periods of losses.
The text mentions permissible drawdown. What does that mean in this context?
It's the maximum acceptable loss for a given period. A trader sets limits to avoid significant losses.
How does limiting the maximum loss amount relate to capital management?
Capital management directly affects your maximum risk per trade.
The text mentions reducing average losses as having a positive impact. Explain.
Lower average losses are equivalent to increasing average profits. This is a crucial aspect of risk control.
What other approaches to risk control are mentioned?
Stop-loss orders, take-profit orders, trailing stop orders, portfolio diversification, and monitoring market volatility are also key risk control strategies.
How does portfolio diversification help with risk control?
It spreads your investments across different asset classes or sectors, reducing your exposure to the poor performance of a single asset.
Why is monitoring market volatility important in risk control?
High volatility increases risk and requires adjusted strategies to mitigate potential losses.
How does the maximum loss amount influence the number of open trades?
A maximum acceptable risk per trade limits the number of positions you can hold simultaneously.
What's the significance of setting a maximum daily or weekly loss limit?
These limits help prevent catastrophic losses from a series of bad days or weeks.
Could you give an example of how setting a daily loss limit works?
If your daily limit is $200, you might avoid losing your entire deposit in 50 days of losses.
So, limiting the number of open positions is crucial. How does that factor into risk control?
It prevents excessive risk exposure in a single trading session.
The text gives an example of 0.3% risk per position and a maximum 6% deposit risk. How does that limit open positions to 20?
Dividing 6% by 0.3% yields 20. This means you can have no more than 20 open positions.
Why is risk control important for a certain time period, like a day or a week?
It helps manage losses and prevents compounding issues across consecutive trading days.
If daily losses reach a limit, what's the recommended course of action?
Take a break and reassess the situation before resuming trading.
The example with $10,000 and $200 daily loss limit. How many days can you trade with losses before losing everything?
50 trading days with losses at $200 per day.
What's the significance of setting daily loss limits?
They allow for recovery from short-term losses and help avoid catastrophic loss from a series of bad trades.
What is a stop-loss order?
A stop-loss order automatically closes a position when the price hits a predetermined level, limiting potential losses.
When is a stop-loss order placed?
A stop-loss order is placed at the start of a trade.
How does setting a stop-loss help with risk management?
Predefines the maximum loss for a trade.
What is the significance of stop-loss orders in a rapidly changing market?
Stop-loss orders help limit losses when market conditions shift unexpectedly.
Preset stop orders are crucial for risk control. Why aren't they used in all strategies?
Some strategies don't benefit from stop-loss orders. My observations suggest that for many approaches, stop losses aren't ideal.
What are different types of stop signals?
Initial stops, trailing stops, take profits, break-even points, and timed stops.
Explain initial stops.
They're related to the entry level, often a percentage or fixed amount.
What about trailing stops?
They adjust the stop-loss level in line with price movements in the desired direction.
How do take-profit orders work?
They close a position when a specified profit target is reached.
Why is a break-even stop crucial?
Moving the stop-loss to the break-even point ensures you've at least recovered your initial investment. Setting it arbitrarily isn't recommended.
What are time stop signals?
They dictate closing a position if market conditions aren't meeting expectations, regardless of losses.
How do you choose a suitable stop-loss strategy?
It depends on the specific trading strategy and the market conditions. Different strategies require varied stop signal types.
Time stop signals are important. Why exit a position if there's no loss?
To prevent losses from mounting if the trade's direction changes unexpectedly.
How is recognizing breakouts of support and resistance levels important in setting stop losses?
Accurately anticipating price reversals is crucial for successful stop-loss placement.
Take-profit orders are preset prices for closing profitable trades. What determines the target price?
Resistance and support levels, Elliott wave theory, or a trader's personal risk tolerance.
How do trailing stops differ from standard stop losses?
Trailing stops adjust automatically with price movements, whereas standard stops remain fixed.
Using an example, how would a trailing stop work with a buy order?
If the price goes up, the stop loss moves with it. It stays put if the price falls.
Why is a trailing stop helpful in this dynamic market?
It allows for capturing profits while managing risk throughout a trend's upward movement.
If a trader sets a $50 entry, $55 take profit, and $45 stop loss, why isn't the full potential profit, $10, realized if the price hits $60?
The stop loss is fixed. Without a trailing stop, the profit is capped.
What's the difference between a trailing and a fixed stop loss?
A trailing stop moves with the price, while a fixed stop remains constant.
So, a trailing stop would adjust the $45 stop loss as the price rises?
Exactly. If the price rises to $52.50, the stop moves to $47.50.
This avoids the lost profit scenario.
Correct. It protects against unforeseen price declines while allowing you to lock in profits along the way.
How does this dynamic adjustment affect risk management?
It offers more flexibility and minimizes the chance of missing out on gains if the price moves further.
Does the trailing stop decrease if the price goes down?
No, it only increases as the price increases.
So, this trailing stop is just attached to the last price mark?
Yes, it stays there until the price reaches that level.
How does diversification help with risk in trading?
By spreading your investments across different assets, you reduce the impact of any single loss.
But isn't owning shares in various oil companies still risky if oil prices decline?
Not diversified enough. Diversification means investing across different industries or asset classes.
How does dividing investments by asset class help?
Bonds are more stable, while stocks offer higher potential returns, but with more risk.
What about sector diversification?
Different sectors perform differently in a downturn, so it protects against sector-specific risks.
What's the importance of looking at correlations between assets?
Low correlation means price movements are less interconnected. This minimizes risk.
What are the recommended limits on investments per asset or sector?
Experts suggest limiting investments in a single asset to 10% of capital and a maximum of 20% within a single sector.
Why is diversifying by sector important?
Different sectors react differently to economic conditions. A downturn in one might be offset by growth in another.
So, investing in both oil and pharmaceuticals could be helpful?
Yes, potentially. It reduces your portfolio's vulnerability to a single sector's troubles.
What about diversifying by country and currency?
It protects against localized political or economic risks. If one country faces problems, you might gain from others.
What's the recommended limit for investments in a single asset?
No more than 10% of your capital in a single asset, and no more than 20% within a single sector.
What's the importance of looking at correlations between assets?
Low correlation means the assets' prices don't move together as much. If one goes down, the others might stay stable or even rise.
How does this diversification strategy affect risk overall?
By spreading your investments across different assets and industries, the overall risk of your portfolio is mitigated.
So, standard deviation measures volatility, right?
Yes, it shows how much prices fluctuate around the average.
How is this helpful for comparing investment funds?
A fund with lower standard deviation has less price volatility.
Why is a lower deviation better in this case?
It means less risk even if the average return is the same.
What's the formula for standard deviation?
It involves the difference between each price and the moving average squared and then averaged.
How does testing a strategy on historical data help?
It shows potential profitability without real investment risk.
What's the main assumption behind this?
Past success suggests future potential.
Is backtesting foolproof?
No, strategies successful in the past might not be in real trading.
Why is adjusting the profitability graph risky?
It can lead to over-optimization, creating a strategy that works well on one period but not others.
What are some important factors in choosing a testing period?
It should cover a long enough time frame and include economic downturns to show resilience.
How long a testing period is recommended for a daily strategy?
At least 5 years to account for market conditions and seasonality.
How does the testing period relate to the chart time frame?
The longer the time frame you're trading on, the longer the testing period needs to be.
So if you're trading daily, 5 years of data is ideal?
Yes, daily strategies need at least 5 years to capture significant market cycles.
What if you trade on a shorter time frame?
A time frame shorter than a day needs at least a year to account for seasonality.
Why is including recessions and crises important?
To ensure the strategy can withstand adverse market conditions.
What are the different testing approaches besides backtesting?
Preliminary testing, forward testing, and multi-currency, multi-period testing are more comprehensive.
How does forward testing differ from backtesting?
Forward testing uses data the strategy hasn't seen, giving a more realistic prediction of its performance.
What does multi-currency, multi-period testing involve?
Testing the strategy on different financial instruments and historical periods to assess its stability.
What's the purpose of assessing performance indicators after testing?
To evaluate the strategy's effectiveness and make informed decisions.
So, evaluating a trading strategy, what's the first benchmark?
Comparing its profitability to a safer, lower-risk investment like a bank deposit.
Why is that comparison important?
Active trading, with its inherent risks, needs significantly higher returns to justify the trade-off.
What's the second comparison point?
Comparing it to a long-term buy-and-hold strategy.
How do you assess a strategy's overall effectiveness?
Looking at profitability, risk, and comparing it to other strategies like buy and hold.
What's a crucial factor in this assessment?
The return-to-risk ratio. A higher return for a given level of risk is a key indicator.
So, what exactly is a current drawdown?
It's the loss incurred initially when opening a position, usually the broker's commission.
How does that differ from a recorded drawdown?
A recorded drawdown is the loss from a closed position.
And what's the maximum drawdown?
The biggest overall loss from the initial capital.
What about absolute drawdown?
That's the total difference between initial capital and the lowest point reached.
Why is understanding these drawdowns important?
It helps assess risk and the strategy's overall vulnerability.
So, what's the difference between maximum and absolute drawdown?
Maximum drawdown is the largest monetary loss, while absolute drawdown is the total difference between initial capital and its lowest point.
And relative drawdown?
Relative drawdown is the largest loss expressed as a percentage of the initial capital.
Why is understanding these different types of drawdowns crucial?
It helps evaluate risk. You need to understand both the potential for loss and how that loss relates to your starting capital.
What's the Sharpe ratio, and why is it important?
The Sharpe ratio measures risk-adjusted return. A higher ratio suggests better returns for the risk taken.
How is the Sharpe ratio calculated?
It's the difference between portfolio return and risk-free return, divided by the standard deviation of portfolio return.
What else matters in a strategy assessment besides drawdown and Sharpe ratio?
The average winning trade size and average losing trade size. These provide insight into the strategy's profitability tendencies.
So, what's the significance of average winning and losing trade sizes?
They show the strategy's typical profit and loss amounts, crucial for understanding profitability.
And how does expected value factor in?
It combines winning and losing probabilities with average trade sizes to predict average earnings per trade.
What about optimization in relation to these figures?
Optimization adjusts system parameters to maximize profitability within a given time frame and for a specific asset.
How does this optimization process work?
It tests different parameter settings against historical data of a chosen instrument to find optimal values.
Why is this historical data crucial?
It helps forecast how the strategy might perform in real trading.
So, optimization adjusts a trading system. How does it relate to changing market conditions?
Market changes affect algorithm efficiency. Optimization refines parameters for the current market.
How is the effectiveness of an optimized system measured?
By evaluating performance indicators for each parameter set, tested against historical data.
What factors are considered during optimization?
Time frames, stop orders, brokerage conditions, algorithms, and confirmation filters.
What's the step-by-step process for optimization?
First, define the strategy, then test, and then refine the search for optimal parameters based on the test results.
What can cause optimization issues?
Lack of constraints on parameter combinations and errors in historical data.
How can those issues be mitigated?
By establishing clear constraints and being aware of data limitations.
Quotation errors in historical data are unavoidable. How do we account for them in evaluating a strategy?
We need to acknowledge their presence and adjust our evaluation metrics to reflect this imperfection.
The human factor is also a significant concern. How can a trader mitigate emotional biases during the optimization process?
By practicing self-awareness, recognizing emotional influences on decisions, and striving for an objective system assessment.
How does a trader determine if a strategy is truly optimal?
Through systematic parameter adjustments, testing against historical data for a specific asset and time frame, and evaluating the performance indicators resulting from these tests.
What if the optimized system's performance differs from real-world results?
The choice of performance indicators and the accuracy of historical data influence this difference. Minimizing the gap requires careful selection and analysis.
What role do different performance indicators play in this optimization process?
They provide a quantitative measure of the system's effectiveness for a specific parameter set, guiding the selection of the optimal configuration.
How does signal generation relate to the trading strategy?
Trading rules generate signals. The strategy dictates the rules.
What are the main components of a trading strategy?
Entry and exit conditions, chosen instruments and timeframes, and potential confirmations.
How does capital management impact signal generation?
Capital management determines position sizes. This, in turn, affects the signal's practical application.
What role does risk control play in signal generation?
Risk control establishes limits. Signals must factor in acceptable loss levels.
How does the testing process inform signal generation?
Testing identifies weaknesses. Strategies need adjustments based on test results.
What are the key factors influencing the effectiveness of a trading strategy overall?
Choosing the right indicators, managing capital effectively, controlling risk, and the quality of testing are all vital.
How do the efficiency indicators impact the real-world effectiveness of a trading system?
The indicators highlight strengths and weaknesses. Comparing these with real-world outcomes is critical.
What are the key goals when comparing optimized system performance with real-world results?
Minimizing the difference between optimized theoretical performance and practical trading results is essential.
What are the main approaches to forming a trading theory?
Technical analysis, fundamental analysis, a mixed approach, automatic theory formation, and event trading. Each has its own strengths and weaknesses.
How does technical analysis work in practice?
It uses charts, indicators, and patterns to identify trends and predict price movements.
What are some key technical indicators?
Moving averages, MACD, Bollinger Bands, RSI, and others. They analyze price and volume data.
How does fundamental analysis differ?
Fundamental analysis examines company financials, industry trends, and broader economic factors.
What's the mixed approach?
It combines technical and fundamental analysis for a more comprehensive view.
What is event trading?
It focuses on short-term price changes related to specific events.
How is automatic theory formation used?
Algorithms and machine learning generate and optimize trading strategies based on historical data.
What is an example of a unique trading theory?
Recognizing patterns or connections others haven't seen.
What are the different types of financial instruments?
Stocks, bonds, commodities, currencies, derivatives, indexes, investment funds, and cryptocurrencies. Each has its own characteristics.
What are the key characteristics of a stock?
Ownership in a company's assets. Shareholders are the owners.
How do bonds differ?
Bonds are debt securities, representing a promise to repay with interest.
What are commodities?
Tangible assets like gold, oil, or grain. They are traded on commodity markets.
What are currencies?
Monetary units of different countries traded on foreign exchange markets.
What are derivatives?
Their value depends on an underlying asset's price. Futures, options, and swaps are examples.
What are indexes?
Portfolios of stocks or other assets representing market or sector performance.
What are investment funds?
Funds that pool money to invest in various assets.
What are cryptocurrencies?
Decentralized digital currencies secured by cryptography.
What are dividends?
Profits distributed to shareholders. often related to the number of shares held.
What is a ticker?
A unique symbol identifying a financial instrument, useful for tracking price changes.
What are the main types of orders?
Market and limit orders. Market orders execute immediately at current prices, while limit orders execute at a specified price or better.
How does the order book work?
It shows all buy and sell orders for a given instrument, displaying supply and demand.
What's the difference between initial and maintenance margin?
Initial margin is the minimum to open a position, while maintenance margin is the minimum to keep it open.
Why is leverage risky?
Leverage magnifies profits but also losses, potentially exceeding your own capital.
What's the goal of a trading system?
To generate income, ideally a consistent source.
How is system effectiveness assessed?
Through testing and optimization, focusing on efficiency metrics and comparison with alternatives like bank deposits.
What are the key modules of a trading system?
Trading theory, testing, capital management, risk control, performance marking, and optimization.
What are some common testing methods?
Backtesting, forward testing, and multi-currency/multi-period testing.
What's the importance of a good trading theory?
It provides the rules and strategies for making sound market decisions.
How can a trader develop a trading theory?
Using approaches like technical, fundamental, mixed, automatic, or event-driven methods, or creating unique theories.
What is technical analysis in detail?
It analyzes price and volume charts, indicators, and patterns to predict price movements.
What is fundamental analysis?
It examines company financials, industry trends, and broader economics to estimate intrinsic value.
How is a mixed approach used?
It combines technical and fundamental analysis for a holistic understanding.
What is event trading focused on?
Short-term price changes related to specific news or events.
What is an example of an optimization procedure?
Optimizing parameter values to maximize efficiency for a given instrument and time period.
What is the role of capital management in a trading system?
To maintain and grow capital, manage risks, and prevent emotional decisions.
What are some common capital management methods?
Fixed position sizing, Kelly criterion, martingale, anti-martingale, and fixed proportional sizing.
What is a stop-loss order?
An order to automatically close a position at a specified price to limit losses.
What is a take-profit order?
An order to automatically close a position at a specified profit target.
How does a trailing stop order work?
It dynamically adjusts the stop-loss price as the price moves in the desired direction.
What is portfolio diversification?
Distributing investments across different asset classes, sectors, and geographic regions to reduce overall risk.
How is market volatility assessed?
Using indicators like standard deviation, examining price fluctuation over time.